the Federal Reserve's bold rate cut last week brought relief to many potential home buyers. But even with mortgage rates slowly starting to ease, most buyers are still staying on the sidelines over concerns about affordability. Can future rate cuts, though, transform this stale housing market into a stable one? Here to share her insights, we've got Kamini Lane, who is the Coldwell Banker CEO. Great to hear you. Great to have you here with us. First and foremost, I mean, just in what you're seeing in the data yourself and the engagements that Coldwell is having with some of its potential clients, how are you seeing people go about the thought process of purchasing a home right now, especially with some of the mortgage rate slippage and continuing rate cuts that are anticipated?
Yeah, absolutely. Well, I think that the rate cut was really well received, right? I think it had been kind of on the horizon for a little while, highly anticipated, and it was a great thing to see because as we've been discussing, we really are in a bit of an affordability crisis in the U.S. today, with housing affordability at the lowest rate since 1985. And so I think that the rate cut did get people off the sidelines, and a lot of it is psychological, right? People have been waiting to see some movement by the Fed, and they saw that movement. And I think that is going to spur an increase in affordability, which should loosen supply, right? Because we've seen that lock-in effect with people who had historically low long-term mortgage rates and were unwilling to give that up. So it should ease that lock-in effect, get more inventory on the market, and that in turn will get more buyers on the market.
Kamini, when we think about the real rates that mortgages would need to come down to ignite a totally new wave of buyers to come in, what is your projection there? What would we need to see rates come down to even have first-time home buyers or home buyers that have been sidelined for years really say, okay, now I think I can make sure that I'm able to take out a mortgage and then give myself good terms for a longer period of time?
Well, rates right now are around the low 6%, right? And while that is a lot higher, let's be honest, it's a lot higher than it was post-pandemic, those 2% and 3% and 4% rates that people got used to very quickly. The reality is the low 6% is very much in line with US historical averages. Now, I think what we need to see is another cut, right? And we need to see more inventory on the market. We need to see price increases stabilize. I think the combination of all of those factors is what's going to get buyers off the sidelines. It's what's going to address the inventory constraints. It's going to address the affordability concerns, and it's going to get the market moving. All of that said, we still are in a robust housing market. Well-priced inventory is absolutely moving. And in many of our metros across the United States, our days on market are just a couple of weeks. And we look at a balanced market as closer to sort of 50-ish days on market. Most of our metros are nowhere near that.
Is now a good time to refinance your mortgage if you've taken one out over the past few years, and or even if more broadly you just are looking at the market and saying, hey, these seem like more favorable terms?
Well, that really depends on the terms of your mortgage, right? Rates have come down, but again, they really aren't close to the rates that we saw post-pandemic. We have a record number of people who have fixed 30-year mortgage rates that are in those 3%. Now, if you have a mortgage and today's current rates and current terms are better than the mortgage that you have today, then absolutely, it's a great time to refinance. And, the reality is on a $400,000 loan, just 1 percentage point decrease in your rate is about $250 a month, and that is significant.